Thursday, May 20th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how the Federal Reserve, their next step is debt monetization, direct debt monetization. That's the nuclear option. And what does that mean? Well, they're going to buy treasuries directly from the US Treasury. That's not what they do right now with QE. They do it through the secondary market. The reason why I'm saying this, even though there's talk of tapering, which really isn't tightening of policy, it's still QE, but how can I say, at a slower pace. And why do I think that monetization, which is really nowhere close to tapering, is the next step? Well, it's because the Federal Reserve is putting the banking system, not just the US banking system, but the whole international banking system in peril. And I'll talk about that today. Try to explain it as easily as possible so everyone can understand it. Just before we go into that, a quick word on Bitcoin and cryptocurrency. Some of you might ask what I think. Well, yesterday proved that Bitcoin is not a stable store of value. It might be a speculative asset, but it doesn't qualify as a stable store of value. It's not something you want to hold to store value, in my opinion. Was I surprised by the drop yesterday? No, because on the 16th of May, I tweeted out this chart, and I said the massive head and shoulder top in Bitcoin daily chart, pointing to a target of around 29,300 over time. And I thought this drop would take a little longer, not 3 days. So yesterday we hit pretty much that target. Bitcoin dropped down to around 30. We're now at 40. So can you really back or have your balance sheet with an asset like this and make it the main backing of your business when it fluctuates like that? I don't think so. And I think it's going to fluctuate even more. If it goes higher, if it goes lower, who knows? So that's all I have to say about that. I don't want to get too many trolls on the comment section. I probably will ignore them. They're not me. Anyone that says he's Monaco 64 and gives a WhatsApp address or talks about cryptocurrencies, ignore it. Maybe report that person as well, and click on it, and it will come up to their YouTube channel, and you'll see that they have no videos. If you click on it and it comes to my channel, then yeah, it's me. So with that, debt monetization. Well, right now, QE, the Fed, basically, let's say the Treasury issues the billions, hundreds of billions or trillions that it does over the year. They do it weekly. The primary dealers at the New York Federal Reserve, which include the major Wall Street banks and also the major international banks, they participate in the auctions, the primary auctions for the US Treasury, and they purchase a lot of these treasuries. But the next day or two, they take these treasuries and sell it to the Federal Reserve. But what happened in March, and also what happened last year after the collapse in March, is that the Fed had to put the pedal to the metal in terms of QE. They've gone from having under 4 trillion on their balance sheet to almost 8 trillion now. So they're doing a lot of QE. And these banks, when they buy these treasuries from the Treasury, their balance sheet inflates. And there's something called statutory leverage ratio. Their balance sheets are supposed to have a certain amount of leverage, and they can't after a certain point. And that's the problem that QE creates, especially when QE gets out of hand, as it's getting right now. But what the Fed did last year is that exempted the big banks from this, they call it SLR, statutory leverage ratio, until the end of March this year. And there's a lot of debate in March this year about whether the Fed was going to extend this SLR, because the problem now is that the Fed has difficulty doing a lot of QE because the banks are not going to be there to help, because they can't let their balance sheets go up too much. What the banks are doing right now to solve that problem, they're trying to encourage their clients not to have cash with them, because that clears up the balance sheet. They're doing something in the repo market, which is basically taking those treasuries they buy from the Treasury and lending them out and taking cash. It's a mess. So there's like a reverse repo problem right now. It's gone, how can I say, parabolic, the amount of repos they're doing, reverse repos. We had a repo crisis, of course, back in 2019 that almost brought the system down. The Fed had to stop their tapering and do QE again now because repo rates spiked to 10%. Now repo rates are going the other way. They've gone negative even in some instances, and it's a huge problem. The Federal Reserve basically is a drunken sailor, and they're putting the sailors on the ship in peril, in danger. And the sailors are, of course, the primary dealers and the bankers. There's a very interesting article on Zero Hedge about this. Fed alert: overnight reverse repo usage soars above COVID crisis highs. So what would solve this problem? Well, there's two things the Fed can do. They can exempt the banks again about the SLR, but that would put the banks in trouble, I think, financial danger. And why is that? Well, because they'd be inflating their balance sheets even more. Volatility in the market could hurt these banks. We're seeing Treasury yields very volatile and rising. So that could be a danger to the major banks. The other thing they could do, of course, is taper and then stop QE. But if they do that, they bring the whole house of cards down. And that's also when you want to have gold and silver, of course, because a lot of counterparties are going to go bust. And I said two, right? But there's three things they can do. The third, of course, is the important one. That is the major topic of this video, is that they basically circumvent the banks and they go directly when there are auctions by the Treasury. The Fed is one of the buyers in the primary market. And that's that monetization. The Fed basically, for all intents and purposes, is already doing that. But doing it for real, it's like Weimar, right? Weimar hyperinflation. That's what the Reichsbank did in the 1920s, early 1920s, 22, 23. And the impact on the dollar would be, we'd have to see, but it wouldn't be good. That would be the nuclear option. So yes, I think that's why the markets are so volatile. Yesterday we saw stocks drop massively, and then they rebounded towards the end of the day. They wheeled out some Fed presidents as usual to try to talk the market up, but they have a problem. And that's why it's more important than ever to keep stacking gold and silver. I think these financial markets are really they look kind of okay, but underneath the surface, or under the hood, or bonnet as they call it in England, things are not good. That engine is really ready to blow up, I think. So Debt monetization. I think that's the next step. They don't have a choice. When they talk about tapering, about maybe raising rates, that's just managing the markets and perception. If they were going to taper and raise rates, they'd be doing it already. And we saw that it failed completely, their tapering and their normalization back in 2017, 2018. They had to reverse that big time, and it led to the repo crisis. So with that, let's quickly look at where the markets are this morning. It's 8:27 a.m. London time. We've got spot gold at 1872. Yes, it was very volatile gold yesterday. The range was 1852 to 1890, up just over $1. Range has been 1879 to 1864. Silver suffered more than gold yesterday because it got mixed up with the general markets and general commodities a bit more, and those had a bad day, of course. But I still think silver and gold are the place to be. These are, of course, the paper prices that the bankers are going to try to manipulate as long as possible. But we know that in the real world, it's a lot more expensive to buy real gold and silver. If you can get gold and silver at these prices, you'd be doing really well, I think. So silver is 27.75, up 4 cents. Range has been 27.38 to 27.93. The Dow futures down 30, Nasdaq is down 20, S&P down 5. So markets are a little more stable this morning. Currencies are a little stronger here. Euro is up 0.15% at 121.94. Sterling is up 1/8% at 141.30. The dollar's down 0.18 versus the yen at 109.03, and the dollar is unchanged versus the Chinese yuan, 643.75. WTI crude is up just under 1% at 63.85. High grade copper up 0.5% at 460.50. And to finish off, the 10-year yield is at 167, down 1 basis points. Yeah, we did trade up to around 170, I think, yesterday, the 10-year yield. It's still not really very volatile, even though yesterday we saw a little bit of volatility. And the other thing that's happening, the very short-term Treasury rates, like the 1 month bills, 3 month bills, they're very near zero or even negative because of all this liquidity in the repo market, which is driving short-term rates to zero, sometimes negative. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.